Good morning. This is Andy Cates from the Global Economics Department at UBS. The key news of note overnight is that, according to the Wall Street Journal, the U.S. government is planning to buy preferred equity stakes in several major financial institutions. These include, among others, Goldman Sachs, Morgan Stanley, J.P. Morgan, Citibank, Bank of America, and Merrill Lynch. The Journal has suggested that not all of these banks, unsurprisingly, are too happy about this, but have agreed to a deal under pressure from government officials. About $250 billion of equity will be purchased, and we'll know a lot more about it when the details are announced before U.S. markets open later today. In other policy-related news, note that Australia's government has unveiled a fiscal stimulus plan overnight worth about 0.8% of the economy's GDP, to some extent, no doubt, designed to alleviate some of the downward pressures on the Aussie economy. Markets, meanwhile, have clearly been giving their thumbs up to what's been announced by European officials over the last 2 or 3 days, and Asia's markets appear to have been giving further applause to the news concerning the efforts that are being reported in the U.S. For the record, we too applaud the initiatives that appear to be on the table to kick-start things like interbank lending and to boost banks' capital. As we keep stressing, however, the sustainability of any future moves in markets will depend on the evolution of the world economy. And to flog Mr. Churchill just one more time, we suspect that in the global economic sphere, we've only just reached the end of the beginning, even if, in the financial sphere, it looks as though we have now well and truly reached the beginning of the end. The lessons of history suggest, even after government-sponsored bailouts, that banking crises render painful macroeconomic fallouts. And it's this prospective pain that continues to keep us in the cautious camp, notwithstanding the wave of relief that's rightly greeted the news from Europe and the US so far. Data that support the idea that the economic outlook in the UK is getting fairly grim came from the latest house price and retail sales surveys overnight. The latest RIC survey, for example, threw out numbers showing the weakest level of home sales in at least 30 years, along with another big drop in the house price balance. Meanwhile, the latest BRC survey showed a fourth consecutive month-on-month decline in like-for-like retail sales. Ahead today on the data calendar, we have the latest ZEW confidence surveys in Germany and the Eurozone, along with the latest business sentiment gauge from France. We think confidence will almost certainly have dropped in these surveys, partly thanks to the events of the past few weeks. We should note, though, that these sentiment surveys were already weakening prior to the onset of the latest financial crisis. Other data due today include some inflation releases in the UK, France, and Spain, and here again the numbers may well be given short shrift, given their backward-looking nature. As we've also stressed repeatedly throughout the past few weeks, inflation has never been an issue after periods of banking sector stress, even when the central banks in question have flooded the system with liquidity, and even when the governments in question have had to issue a lot more debt to help bail banks out. That's all for today. Thanks very much.